Welcome back to my channel, and in this video we're going to talk about the 6 costly lessons to market crash when it comes to investing. I actually have another video planned after this, which is the 6 investing styles for beginners. So if you want to watch that video as well, then make sure you subscribe and wait for that video. So when it comes to this video, there's actually a backstory to the 6 lessons to market crash, and it is really my history of failure over time. So if you watch my webinar that is on my website, it is a very comprehensive 3-hour training, then you'll notice my history of failure. So let me just show you the slide right now. In 2008, I tried day trading and it didn't work out. I tried Forex with leverage, which is very risky, it didn't work out. And I tried technical analysis. I tried developing and programming automated trading strategies, and I tested over 300 of them, and it didn't work out. And I tried value investing, it was too time consuming. I tried listening to my friend's advice. That went horribly because the company went bankrupt. And I invested in some junior gold mining company, which didn't work out. And I invested in airlines right before COVID. And I also invested in Alibaba during a Chinese regulation as well. So when it comes to the market crash, I'm really talking about the 2021 and 2022 market crash. And these are actually the 6 costly lessons I learned along the way over the last 13 years. Now, during this market crash, I actually recently made a very good gain. So I exited one of my gold position because of the Russian and Ukraine tension. I saw the opportunity a year ago where gold was going to go up. In fact, I actually said it was going to go to $2,000. And it hit $2,000 and it quickly retraced along with oil price hitting $120 something, $130, and quickly retraced down as I'm recording this video. I actually invested in a gold mining company in Canada called AEM, which previously it was Kirkland Gold, which is the company I invested in, and it got merged together with AEM. So I had quite a significant position there, which is approximately 200K, and I made approximately 30 to 40% over the last 1 year and 4 months. Here you can see my interactive broker screenshot where I exited my position just today as I'm recording this video, and I net around 30 to 40% gain. So obviously there might be some additional room for AEM to go up, which I think it's fine, but for now I'm pretty happy with the profits because I do want to reallocate that cash to more discounted opportunities that we are analyzing and studying in Investing Accelerator. Within the community, a lot of students also took on the opportunity to invest in this gold mining company as well. So let me share some student success with you as well in Investing Accelerator. So Ahmed made 45% in 2 weeks. He's actually a new student in the program. Roy made 73% in a year. Chris made 48% in 8 months. Mike made 40% in 6 months. Colin made 30% in 9 months. And Sherry made 130% in 2 weeks. And she's also a new student as well. So here you can see how we are tracking different industries, looking for opportunities, and we enter into them and we make a good profit. So with that being said, let's dive into some of the painful lessons I learned along the way. So lesson number 1, there's no such thing as an invincible stock. Now, when you're investing before 2021, there are stocks that you know that just cannot fail, like Shopify, like Facebook, like Netflix. And these terms that get thrown around that seems to be invincible stocks that never seem to go on a discount. Guess what? They're at a discount right now. And if you think back to what is happening in the markets, there's actually a couple of steps that are happening in a very short amount of time. And most people don't realize or haven't caught on, or so they're not able to react fast enough. During COVID, the market went down for a very short period of time. Fed printed a lot of money, which inflated the stocks significantly. Now Fed is going to stop printing as much money, which causes a lot of fear with the increase in interest rate and basically delaying the crash until 2022, which a lot of the stocks are now dropping because of that. So the COVID drop you're supposed to see which is supposed to be more severe, is delayed for almost 2 years until 2022, where you see majority of the drop. So a lot of people who retired or made the decision to retire with that information need to probably go back to work or reevaluate their portfolio, because whatever has gone up because of COVID and all the money printing is coming back down. And one good example is actually Facebook. Another example is Shopify and Netflix and so on. So let me just jump over to the charts to show you what I mean. So some of the examples I included here is NVIDIA, AMD, Netflix, HubSpot, Facebook, excluding Amazon and Apple for now. So in fact, Amazon actually has a discount, and they recently announced a 1-for-20 split, and Apple is actually still going pretty strong as well. So except these two, the other invincible stocks are actually going down. So here we're at Facebook. So let me just shift that over. Now, what you'll find is that before COVID, Facebook was actually at around $200 something. And here you can see there is a very small drop. Now, usually, if you study the 2003 SARS Hong Kong market crash, it actually goes a little bit deeper. But nevertheless, Fed start printing money. So then you can see this giant rebound to almost $400 something here. And then after they start, tapering or reducing the amount of bond purchase, it comes crashing down, and now it's back to the pre-COVID level. So even though Facebook is such an invincible stock, it can still drop so much. Now, another example is HubSpot. So this is a software as a service company where it is quite strong. It has a very good sales team. The financials are good. It's growing year after year. And here you can see that before COVID, it was actually close to $200. Okay, let's use the higher price. And then after COVID, it has grown significantly all the way to, let's see here, $700-800. So my face is kind of blocking it, but it's around $700-800. And then afterwards, it dropped around 50%. So you can see all the gains here, 50% is given back up, and now is at $440 as we speak. So you can see that there's no such thing as an invincible stock. I think when you're looking at these macroeconomic events, you need to be very careful of how they're shifting the industries around. Because of a war, the oil stock, gas stocks, and defense stocks are up. So if you watched the previous video where I talk about the 9 tips to invest in 2022, then you will find that you're able to invest in gold stocks or oil stocks or defense stock early enough, so then you are able to make a profit on it. So in fact, if you actually watch that video and you study some gold stocks during that time, you would have made quite a good profits, like some of the students in Investing Accelerator as well. So here you can see the industries are shifting because of the macroeconomic event, even though the company itself is very strong. So for something like HubSpot, you can see it dropped 50% from the top. So that is a significant impact to a lot of people who invested in it. Even though it doesn't usually go on a discount very often, you can see it is at a very deep discount because of that. So another example is Netflix. So if you look at Netflix, you can see that it has gone up from the 2020 drop, like $300-400, all the way to approximately $600-700 as well. So you can see there is a giant increase, and now it dropped all the way back to the pre-COVID level, which is around $350 or so. So if you zoom out, you will see that Netflix is usually not at such a deep discount. So then it might, trick you into thinking that, hey, this kind of stock never have a discount. I'm just going to buy it at the highest possible price. Well, while it is okay if you buy and you average in over time, kind of like dollar cost averaging, but if you just buy right before a crash like this one, then you're going to lose 50% of the value. And that is really going to crush your confidence as an investor. So that's why when you're thinking about, investing, you do want to invest at a discount. Even though you're getting a small discount, try to invest at a discount if you're able to find stocks that are at a discount that are good companies. If you're wondering how I'm using this chart, then it is actually something I teach within my free webinar on how to get 30% return. So then you can check it out in the description as well. So here you can see Netflix actually dropped significantly. So there's actually an opportunity here. If Netflix turns around, then you can see that it is at a deep discount. So that's why in Investing Accelerator, we focus a lot on buying discounted stocks, because you will find that it is easier to get 30% return. So it's like going to Boxing Day and you're trying to buy a piece of clothing and it is 50% off. It's much easier to buy something at 50% off and then try to make 30% from it than buying something at the full markup and expecting someone else to pay 30% more a year from now. Now, the second lesson I learned during this market crash is that all the money printing gains will be given up eventually. Now, what you observe during this crash is actually very interesting because the sectors are shifting so quickly. So initially during COVID, you have all the companies going down altogether. And then investors figure out which companies will benefit the most from staying at home, working from home. In this case, these are mainly software as a service company like Zoom, like HubSpot, like Shopify or whatnot. So then these companies went up significantly. And then now we're shifting into the post-pandemic world, and all these companies are coming and crashing down to the pre-COVID level. Now, over time, if you look at the year-over-year inflation, which is approximately 3% per se, then that money printing usually stays within the market and inflates all of the asset prices over time. But then the short-term money printing gain, like what we're experiencing right now, will go away, and that's when you get a lot of people losing money, like half of their portfolio. Lesson number 3. Now, if you're a long-term investor, this is important because when you're analyzing a market crash, you'll realize that it actually wipes out the last 1 to 2 years worth of gains. So for example, if you're looking at Shopify or Facebook, for the last 1 to 2 years, you get that giant rally, and then the market crash will wipe that out temporarily. And if you exit at the lowest low, then of course you give that all up. But if you're a long-term investor and you have the patience, then you would hold through that dip to exit at a more reasonable price because you know the market is irrational. So while you might feel very defeated during this down point in the market crash, you need to kind of step back and take a look at what is a reasonable price that you can exit. Now, if you're able to use options, then of course you can try to use hedging or writing option strategies to generate some income. For example, like 1% a month, or reducing your losses by half to reduce that risk. So which is quite important to learn options if you are planning to actively manage your portfolio. Lesson number 4. Timing the market is hard, but then if you learn how to hedge using options, then you can protect yourself at very specific intervals. And I find that it is best time to hedge before earnings, because during a bear market, usually earnings can be very unpredictable, and then you will find investors are shorting the earnings regardless if it is good or bad, or if the forecast is good or bad or whatever, and it might go down. So then you want that protection just before earnings come into play. So if you don't know what hedging is, you're basically using a short-term put option to reduce your downside before a significant downward move. So you're trying to use very little money as insurance to cover majority or at least half of your losses. So then if it goes against you, then your put or hedge position will make a lot of money, and then your call or your long position will still be intact, and then it reduces your average cost, so then you're able to ride the wave with less emotional trauma. If you're in a bull market, then generally earnings goes up, then you don't really need to hedge. So that's kind of what we teach and use in Investing Accelerator. The 5th lesson is that there's actually a lot of management change during a bear market, like CEO stepping down, CEO jumping ship to another company, a CFO is, resigning, or the founders are quitting and they suddenly are able to retire and they decide to get a new CEO to come in. So let's be honest here. Most of the time, you're not going to be able to predict when a company will change their CEO. But if for some odd reason you know that they are going to change the CEO, then you want to avoid these companies. And based on my experience, I find that most of the companies that change their CEO will have a significant drop if they don't notify the investors ahead of time. If they have a sudden change, this can be like a 20-30% drop, which can be quite significant. And the Starbucks stories is actually quite interesting because I was invested in Starbucks during that time and the new CEO came on. And he said, oh yeah, Starbucks, we're not going to be growing anymore. We should expect a very low growth rate going forward. And then Starbucks dropped like 20-something%. And then a couple months later, he came back with a growth plan to expand Starbucks with hundreds of stores in China. And obviously, investors loved that. And then Starbucks stock price rallied significantly after that. So you can see how a new CEO having the wrong plan, saying the wrong things, can lead to investors losing confidence in the short term, and then later on gaining that confidence back once the CEO is acting properly. So for that Starbucks investment, one of the students in the program invested during that dip, right after the CEO said something stupid, and then she got in at a good price within investing Accelerator, and I think she made around 40%. So the last lesson, lesson number 6 of the market crash, is that when you're investing in these bad events, sometimes there are multiple black swan effects. So for example, when you are looking at China regulation, initially Alibaba was going to IPO Ant Financial, and then China blocked it. And you would think that is over, but apparently not. And then afterwards, China starts regulating Alibaba. Jack Ma came out and said something stupid, and China regulated Alibaba even more. And then now they're taking Ant Financial into a JV and kind of splitting it, all the important parts, and then getting even more regulated, so on and so forth. So then you just get many of these black swan effects hitting the same company over and over again, which drives the stock price of Alibaba down from $300 to $100-something. Even if you invest in a great company like Alibaba per se, if it gets hit by 5 black swan events in a row, then, well, there's nothing you can do about it other than you hedge that position. So you would hedge that position, and every time it goes down, you would continue to hedge it, and you would be able to reduce half of your losses and basically recover that back through your hedge position before this all happens. But of course, once it drops so much, then there's really nothing you can do about it anymore. So it's just what it is. So for lesson number 6, it's really about not concentrated within one black swan event. So I see a lot of people, when they come to me, they schedule a call with me, and I look at their portfolio, and they said, oh yeah, my entire portfolio is in technology. I love technology, and I'm all about growth tech, which is AI, EV, VR, so on and so forth. And you'll find their entire portfolio is down because the entire sector is down. So no matter how good you are at stock picking, if you only pick everything in tech and tech goes down, which it does, and it did, then you lose half your portfolio. Now, for some people who are able to stomach that loss, then of course they're able to handle it. But for people who are, emotionally fragile, then perhaps they're not able to do that because it is very difficult to invest in a company that you lost 50% in and hold for the next 10 to 15 years, thinking that it will come back up. So when you are investing, it is important to have a diversified portfolio. And this is especially apparent in the last couple of weeks, where I have a good number of technology stocks entered at a discounted price. And I know that these ones wouldn't be profitable yet. But then if you look at my significant position, which is the gold company I just talked about in the beginning of the video, then you'll find that, hey, it is going up, made 30-40% from it, and that is a great gain. So my entire portfolio overall is actually up 10% this year already, while S&P 500 is down 10%. So that is really important. When you need to diversify, you might have one sector that you invested in, which took some time to mature and go up, and then you have another sector like technology that is not ready yet. So if you have your entire portfolio in technology and it gets hit by one black swan event like interest rate increase, then there's nothing you can do about that portfolio because there's no way you can maneuver between the sectors because everything is in one sector. So that's why when you're investing in a portfolio, you need to diversify it just enough so then you're not concentrated with one black swan event. You just need to figure out where the blind spot is so then you can be more confident when you're investing. One of the things I do when people hop on a call with me is that I take a look at their portfolio to see if there are any obvious mistakes, like if there's any obvious things they can do to correct or clean up their portfolio so that they can become a better investor. That's why in my coaching program, Investing Accelerator, we focus a lot on analyzing the major events or disasters that happen in the market. There are 3 parts to Investing Accelerator. The first part is online video lessons where you learn the entire investing strategy, which includes long-term and also monthly passive income. And you need monthly passive income if you're planning to retire within the next 5 to 10 years and you want to generate a good return. The second part is weekly group coaching call. During the weekly group coaching call, we analyze the major macroeconomic events and we try to plan ahead to see how we can maneuver around or take advantage of any significant changes in the market. Because there's so many things happening in the market, we just need to look at it on a weekly basis, kind of around 1 hour a week, then it will be sufficient. And finally, the third part of the program is the private Facebook community. So that's where we get to interact with other students in the program, and you will see other students asking questions and what they're buying or selling as well. So if you're interested, then you can click on the link below to register for the free training, which is around 3 hours long. It's a free case study. And then after you watch the free case study, then you can hop on a call with me or my team and see if you're a good fit for the program. So this year, I'm planning to accept approximately around 200 to 300 students in the program. So if you want to be one of them, then you can click on the link below and register for the free training and then schedule a call with my team. And if you're a good fit, then we'll get started and see what you can do with your portfolio so then you can grow it at a faster pace. So that's pretty much it. For the next video, it is going to be the 6 investing styles for beginners. So if you're very interested, then make sure you hit subscribe, like, and leave a comment as well. Did you learn anything in the last 3 years during this market crash? Like, are you able to exit and keep majority of your profit? So you can leave a comment below, and I'll see you in the next video.